Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for exercise 1610. Intermediate Accounting textbook authors are Don Cuso, Jerry Weingen, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so let's get the accounting party started. Set it, gotta go with it. There we go. Okay, so we're looking at exercise 1610. And by the way, if what I'm showing you is really hard to read on the screen, I apologize. However, if you go to zlibrary.org, and if I come over here and I do a search on books and I type in intermediate accounting, what you will be able to do is you will find the very exact textbook that I'm pulling this from for free. So zlib.org, great little website, lots of free materials. And, so again, if you have trouble going through and reading these, that's where you can find them. Okay, so right over here, on November 1st, Colombo Company adopted a stock option plan that granted options to key executives to purchase 30,000 shares of the company's $10 par value common stock. The options were granted on January 2nd. And were exercisable after the date, 2 years after the date of grant, if the grantee was still an employee of the company. The options expired 6 years from the date of grant. The option price was set at 40, and the fair value option pricing model determines that the total compensation expense to be 450. So let's talk a little bit about stock options. So when a company goes through and offers stock options to its employees, first thing they're going to do is they're going to go talk to a compensation consultant. Generally, when you're setting aside shares of stock, there's a lot of different ways to do it. But if you are a publicly traded company, you will generally adopt a stock option plan that has to be accepted, approved by the shareholders. So you'll see that come up in a shareholder election. And what it's usually done on the SEC forms, it's done on something called on a Form S8. So that's typically where you will go through and see it. Now, they're very kind in telling us what the option pricing model is. But if you're looking to go through and see, how this actually works, you can go to this right over here, Black-Scholes calculator. And if you go through and you look this up, you'll be able to kind of go through and see how to go through and determine the value of the options. So right over here, you put in the stock price, the exercise price, the time to maturity, the annual risk-free interest rate. This is, again, something you'll probably get from like the federal funds rate for a similar, I think it's for a treasury security. And then the volatility, that's going to be something that you're going to have to go through and find. There are volatility calculators that are out there, but again, this is something that it's going to be a little bit more advanced. But if you are, when you start working for a publicly traded company, the answers are all out there. Okay, so what's going to happen over here on November 1st? We don't really do anything in 2020 because we're just approving the plan. However, the options were actually granted on January 2nd and were exercisable 2 years after the date of grant if the grantee was still an employee of the company. The options expired 6 years from the date of grant. The option price was set at 40, and the fair value option pricing model determines the total compensation expense to be 450. So if we kind of look at this here, what we really are trying to do is for our company is that we granted the options on right over here. We granted the options on 1/2/21. And in order for the employee to receive the benefit of these, they'd have to be in the employ of our company for a period of 2 years. or 12/31/22. Okay. 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 So what we're going to do is we're going to go through and recognize stock compensation expense for 2021 and 2022. So let's go through over here and figure this out. So prepare journal entries related to the stock option plan for 2021. So on 12/31/21, because this compensation expense is giving us benefits for a period of 2 years, I'm going to go ahead and debit stock compensation expense. I'm going to credit additional paid-in capital stock options. So over here, this is going to be recorded at half of the fair value, which they determined to be 450,000 or 225,000. And what we're going to go ahead and do is basically do the same journal entry on 12/31/22. So that's what we're going to go ahead and do. And what it then goes through and tells us is that all of the options were granted. So that's where the 225 come from. It's basically 450,000 divided by 2 because it's a 2-year service period. Remember, the stock compensation expense is really kind of going through and tracking with the ways our employees are going through and working. So we don't really care about the option expiration from the date of grant. It's really about what we care more about is that, well, are they still with the employee of the company or whatever may have you. So right over here, it says all the options were exercised during 2023, 20,000 on January 3rd, when the market price was 67, and 10,000 on May 1st, when the market price was 77 a share. We do not care about the share price. It may come into play if they're doing a cashless exercise, but generally for us, what we're really kind of looking at here is how much cash are they going to give us? So when we get to 1/3/23, how much cash are we going to be receiving? Well, the amount of cash we're going to be receiving is going to be 20,000 times 40. Okay, so this is 20,000 shares times $40 per share. Okay. Now, at the same time, what I'm also going to be doing is I'm going to be saying, okay, additional paid-in capital stock options, because they're going through and because we are going through and they're exercising these stock options, we're going to go ahead and take this part of the additional paid-in capital off of the books. So what we're going to record over here is we're going to have the total amount of additional paid-in capital is 450,000. And what I'm going to do is I'm going to multiply this 450 by 20,000 shares over 30,000 shares. So my total amount of my additional paid-in capital that relates to these stock options is going to be 300,000. So for the rest of this part over here, I'm now going to go through and now account for the issuance, which is going to be common stock at par. My common stock at par, this is going to be $10 times 20,000 shares. Okay. The other part over here, what I'm also going to be going through and doing too, is I'm going to be crediting additional paid-in capital common stock. And this is essentially going to be for the balance of what we have, or this is going to be 1.1 million, 200,000. So this should be 900,000 in terms of that price over there. Okay. So this is basically how we go through and compute this. So the other part over here is now we're going to go ahead and look at what happens on 1 over here. Our next one is going to be on 2. Let's see here, on May 1st, when the market price was 77 a share. I don't really care about that. So on 5/1/23, I'm receiving cash. Again, I'm going to be getting a check for 10,000 shares at basically 10,000 shares at 40. I'm going to be crediting additional paid-in capital stock options. So be debiting additional paid-in capital stock options. This is going to be 450,000. I'm going to multiply this by 10,000 because the remaining of these are being exercised. So this is going to be times 1/3 or 150,000. I'm always going to be recording common stock at par over here for the 10,000 shares times the $10 per share. And then my balancing amount is going to go to additional paid-in capital common stock. So over here, what I need to do to go through and balance is I need 550 in terms of credits. So this is going to be 450,000. Okay. Okay, so one of the things just to kind of think about here is that what you will notice is that when I'm looking at additional paid-in capital common stock, now some of you might be saying like, Bennett, look, dude, 10,000 shares at, this is 10 a share because it's 40 a share. This should really be 10,000 shares at 30. But the real issue is here is that those stock options, clearly when they were going through and doing the pricing, their value turned out to be greater than the market price per share. So this is why we're going through and doing the journal entry this way. So this is how we would go through, and for exercise 1610, this is how we would go through and approach this particular question. Again, the market price has nothing to do with how we go through and recognize the value on these stock options. So thank you for allowing me to make this presentation for you. I also want to thank Wiley for allowing me to use their questions. Please don't forget to like and subscribe. If you'd like to see other solutions, please feel free to ask for them in the comments to the video. Look forward to seeing you on the next video. Have a great day.